You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, I was actually on vacation for about a month, and Mark filled in with me and all the great people at Options Insider, helping me come up with some solutions for my podcast the last 3 or 4 weeks. So now we're back into the swing of things. We have a lot going on. The S&P 500 index continues to set new highs. As a matter of fact, it set a new high today, which I should mention what today is. Today is Wednesday, August 25th. The markets are open right now as we tape Options Playbook Radio, and we see the S&P 500 index right now is trying to get to the 4,500 level. We'll see if it does today. It's up about 11 points on the day. We have the VIX index has kind of creeped up. Well, we had a big spike up last week because of the downturn, and now we see the VIX trading at fairly close to the 17% level. The Fed is going to be out in Jackson Hole. They're going to be talking, and then they're going to talk to us, the public, about what's going on and what some of their thoughts are. So I'm going to do a trade just based off of the S&P 500 index this week, and it's kind of an old standby trade. We always have an adjustment for this trade overall, but when we have a little bit of an elevated VIX, I like the VIX around 17, 18% when I'm looking at doing this trade. This trade can be done in the S&P 500 index, the actual SPX. We're not talking about the ETF, the SPY. We're going to do this in the actual SPX index. And what we're going to do is a long call spread going into this Fed announcement. See what happens with it. We just set a new high in the S&P 500 index. And a lot of people have been talking about the buy the dip mentality that has been happening. If you actually look at the 50-day moving average in the S&P 500 index, it's been a long time since we've actually stayed below the 50-day moving average for more than one session, i.e. 2, 3, or 4 sessions where the S&P 500 index actually hung out below that 50-day moving average in the S&P 500 index chart. So buy the dip has been a phrase that has really been talked about by a lot of the financial media. And so we're going to kind of look into this. Now, this might mean that we're a little frothy, and I do agree with that. We are a little frothy relative to the 200-day moving average, and we had a very strong but boring bull market, if you will, in that we're not jumping with leaps and bounds, but we do continue to seem to set new all-time highs in the S&P 500 index, and the NASDAQ is coming along. The Russell is the laggard. It's just kind of hanging out there in a channel, trying to figure out where it wants to go to. But with that said, let's get into today's strategy. So the last trade that we had on the S&P 500 index right now, if I just freeze frame it, is at 4,498.11. It's up $11.88 on the day. The concept of doing the trade that we're going to talk about today is the fact that there is always so much time premium in the S&P 500 index, a lot because of the value of the index, the fact that it is a 4,000, basically 500 point index, and we have a little bit of an elevated volatility. And because of that, it makes doing long spreads, particularly 5-point wide long spreads, where we're going to be selling the most at the money option contract and buying a little bit in the money option contract, fairly cheap. When the VIX is higher, it's cheaper to do these type of trades than when the VIX is trading down around 12, 13, or even 11, if you will. So we have the Fed. We have a little bit of elevated, I think, VIX index because of the fact that they're going to be speaking on Friday. And so we're going to do a trade based off of that. And as always on Options Playbook Radio, nothing is meant to be a recommendation. We want to look for when strategies that are inside the Options Playbook, which you can find at optionsplaybook.com, apply to a certain scenario. And I think that this strategy definitely applies to this scenario. And I don't mind doing when we get elevated VIX, because a lot of the times the Fed is going to be speaking, or we have a certain scenario that will happen. I like to manage my risk by doing a long spread, and I like to sell as much time premium as possible. So in this instance, I'm going to go to the August 27th expiration. Now, we're taping Options Playbook Radio. It is a Wednesday. If this was a Monday, I would probably do the standard Friday expiration. But in the SPX, we have a plethora of different expirations to choose from. So we'll be able to talk about this trade next week on next week's podcast, because we'll already know what has happened to the trade. And so I'm going to actually go over the weekend with this. Most of the time, I don't want to necessarily be in a speculative position over the weekend, but we're going to be managing our risk by the price that we pay for this trade. So the August 27th expiration, right now the SPX is rounding down at 4,498. We're going to go in the money and we're going to sell the 4,400. We're going to buy the 4,495 strike call. That's 4,495, a couple of points in the money. We are then going to sell the 4,500 call, which is a couple of points out of the money. And we can get that 5-point wide long call spread done for a net debit of $2.90 plus commissions. Got to add commissions in for this 1-by-1 spread. That means we're going to risk $290. Now, we're already in the money on the call option. We're selling more time premium than we're buying in this instance. So if the market stays where it's at, or even drifts down a little bit, just a smidge, we are actually going to be profitable on this trade. So we're buying a spread, we're paying for it, but time decay is our friend. And that's what our goal is here with these S&P 500 index option contracts, is to make time decay our friend, because there's so much of it in the last few days to expiration in the S&P 500 index. It's just a fact of the valuation of the actual index. So in this scenario, if we pay $2.90, that's going to be our maximum loss on this trade. We cannot lose any more than the net debit that we pay plus commissions. Our upside here is $2.10. So $2.90 plus $2.10 equals $5. You have two scenarios where this trade actually works for you. If the stock just stays where it's at, you get a little bit of time decay, I should say the index, then that's going to work out for you. If the market goes up, well, then a no-brainer, a very simple trade. You can just close it and get out. You should get fairly close to that $5. If the market goes down, we have minimized our risk to the $2.90. But if that happens after Friday, after the Fed speak, we do have the weekend and we have a little bit more time premium in there. One of the trades that I'm going to talk about, and I will make note of this on Friday, is that we can roll into what's called a butterfly spread. A butterfly spread is basically a combination of a long spread, like our trade of the day today, and a short spread. So in this instance, we are saying we're going to be long the 4,495 strike call, and we're going to be selling the 4,500. To make it a butterfly, you would then sell the 4,500 and buy the 4,505. So in other words, I'd go 5 points up. I'd keep this 5 points wide overall, and I would actually sell that credit spread. Now, right now, for example, with only a few days remaining, the option contract that we're selling, the 4,500, is still trading for $10.50 at the midpoint. So there's still a lot of time premium, even though we're only going out to this Monday, August 27th. So the concept is that on Friday, if the market does go against us after the Fed speaks, or actually even before, who really knows where the market's going next, right? I would then think hard about just rolling into the butterfly trade here. And what that does is it takes some of your risk off the table. If I could sell that credit spread and still bring in approximately $1, then I'm going to lower my risk to 190, and I'm still going to have a toe in the water, kind of hoping that the market may come back. Now, in this instance, how far away can it go where that spread might still be trading for $1? It would probably go down 15, maybe even 20 points from where the market is at right now. And you still would be feasible for you on Friday to maybe sell that credit spread and roll into the butterfly. So it's a two-step process. I don't want to make it a three-step process. I really don't believe that when you're trading option contracts, especially on a shorter term basis, that you're going to make unlimited adjustments to a position. We're going to put the position on. The market stays where it's at or goes higher. Time decay is on our side. We are going to profit on this trade. If it definitely goes higher, then it's a no-brainer. Market comes down, goes below our long strike, the 4,495 strike call. Well, then we got an option. We're going to look at maybe rolling into a butterfly by selling a 5-point wide credit spread on the upside, selling an additional 4,500 call and buying the 4,505 call and bringing in a net credit to reduce my overall net risk. Now, the one thing that I love about this trade as a hedge is that you are not adding additional risk. When you're in a normal butterfly position where all the wings are the same width apart, you got the 490, 4,495, 4,500, and 4,505. That means it's a 5-point wide butterfly. And if you do that trade, you don't add additional risk. We sell a credit, bring in some cash, but we do not have any more risk. We haven't added any more risk on the table. Now, with that said, you might say, well, why doesn't everybody do this? Well, if I just close out the trade, let's say I was down, the market did go down, let's call it 20 points or whatever. Usually just selling your long call spread will net you a better credit to the account than selling the short spread. But once you close out the long call spread, you're done. You're out, right? You're completely out of the trade. You're selling the close the 4,495, buying the close the 4,500. In our scenario here, we're keeping a toe in the water. We are going to bring in a credit, reduce our risk a little bit, but if we did get the market to land somewhere between our long strikes of our butterfly, 4,495 and 4,505, well, then we can potentially get our money back. We don't want the cheese anymore. Just let me out of the trap, or even be profitable, because this could be trading for as much as $5 if it goes out right at our 4,500 strike. Now, one other little thing that's kind of wonderful about this little trade is that, and I use wonderful with air quotes, is that we're talking about the S&P 500 index. So they're cash settled at the end of the day on Monday, the 27th. So you don't even necessarily need to trade out of this. If you just let it come back and it lands somewhere within that range, you don't have to worry about buying the S&P 500 index. All that happens is if you are in the money and you do some cash, you get the cash. If you are out of the money and not do some cash, all the options expire and you're just all good. So that's one of the neat benefits of the index options, is that they are cash settled. They don't settle in actual securities, i.e. stock in this instance. All right, so let's go back and do a quick review. I think this is a solid trade for my first time back after being away for a few weeks. We're going to do a long call spread in the S&P 500 index ahead of the Fed meeting on this Friday. The market is at 44.98 approximately. It's live. It's rocking and rolling right now. We're going to go a little bit in the money and use the August 27th expiration, buying the 44.95 strike call and selling the 4,500 strike call. Right now, the midpoint is at $2.90. That's $290 plus commission. That would be your total risk for every 1-by-1 spread that you put on. The maximum this could trade for is $5, which is the width of the spread, minus that $2.90 means you have $2.10 worth of upside, less commissions, of course. And our expiration date is the 27th. The Fed speaks on Friday. I'd look to adjust this trade before the weekend got here. When Monday comes, it will probably be too late to make an adjustment. Time premium will have eroded too much. So I'm going to keep an eye on it. It's not a trade that you're just going to place it and then just let it ride. Ideally, we have a hedge for this position if the market does go against us, and that hedge is going to be to roll into a butterfly. And that's going to be it for this episode of Options Playbook Radio. If you have any questions you'd like to ask or anything that you would like to talk about on the program, please email me at theoptionsguy@invest.li.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available on the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.